All right, there we go. Welcome in, Terry. We have Maya with us tonight. She was introduced to us through Tristica. So she was here Monday, and we're going to go ahead and get started. Just some basic etiquette. Stay alert, attentive, and engaged in what you're learning. Keep your distractions to a minimum. Be sure to mute your mic until the floor has been open for you to speak. But if you have questions, especially since there's just a few of us, feel free to come off mute and ask your question. We'll keep going. There'll be a time for question and intermission though. So because of the pace of it, I like to try to get through it. There's a lot to cover tonight. So write your questions down. You can put them in the chat. My co-host, let me see, I'm gonna make Terry a co-host as well. Can answer questions for you in the chat as I'm going as well. All right, and remember, this study session is designed to help you, okay? So it's designed to help you provide a solid foundational knowledge of what you're about to behold, but it is not the primary source of your knowledge. You will need to study some on your own. You will need to refer to your Excel study materials. You will need to take those practice exams many times over so that not only you learn the information through taking the practice exams, you go through the exercise of answering those questions as you might see them on the exam. You build the confidence that you understand and know how to answer those questions correctly so that you can successfully pass the exam with a score of a 70 or higher. All right. So just briefly about your exam. It's going to be an 82 question exam. If you're taking it in the state of Tennessee, 60 questions are going to be related to insurance processes and terms, and 22 questions are going to be related to the state laws. You need to score 70 or higher. It's computer-based testing. You can take it online or you can go to a Pearson VUE Center. There's one in Brentwood where you can take the exam, a proctored version of the exam, and then all multiple choice answers. So the questions are all multiple choice, very similar to tests you've taken before in high school or college. So that should allow you to rest easy. As long as you know something about the information, you can make some very strong guesses or responses to those questions. But you won't have to guess because we're getting ready to cake on the foundation of your knowledge from what you learned on Monday. So let's see, we had one more person come in. I think it was Tamika? Tarika, sorry. And if I'm saying that wrong, please forgive me, but welcome, Tarika. All right, so life insurance policies. Today we're covering the types of life insurance policies, okay? There are two general categories on how life insurance policies exist in terms of ways you can think about remembering them for the test. Okay, there's policies based on the length of coverage, and then there's policies based on the investment choice or the flexibility of the policies themselves. So the policies based on the length of coverage, the two main categories there are term and whole. Okay, so a term life coverage or whole life coverage. Term life coverage is a temporary protection, generally 10, 20, or 30 years. Okay, the temporary coverage, if you have insurance coverage from your job, from your employer, more than likely it's a term life policy. Whole protection is exactly how it sounds. I want you to get used to looking at the words and taking them for face value so that when you see them on the exam, you can break them down and understand what it's saying to you. A whole life policy protects someone's whole life, okay? If you understand that, you kind of already know, some confidence, you already have some confidence there. All right. You're also going to make payments on that policy for your whole life, or a person's whole life, the insured's whole life. We'll talk about that later. But a permanent protection, whole life insurance is also known as permanent insurance, okay? It's for a person's entire life. There are policies that are based on flexibility or investment choices, adjustable, universal, and variable. Adjustable policies can be either term or whole life policies. They can convert from one to the other. So an adjustable whole life policy is a whole life policy that can be converted to a term life policy. An adjustable term life policy is a term life policy that could be converted to a whole life policy. Okay, so when they say adjustable term life, it can be converted from term to whole. Adjustable whole can be converted from whole to term. Universal, a universal life policy is permanent insurance. So it's a whole life product, a whole life insurance product with a variety of flexible options. Universal, think about a universal remote control, okay, that you control your TV with. If you go to Target or Walmart and buy a universal remote control, it can work for almost any TV, right? There's a variety of TVs that it can work for. It's flexible with no matter what kind of TV it is, right? That's a universal, it's permanent insurance, right? A remote is a remote. It'll work for the TV, but it doesn't matter what kind of TV, it has a lot of variety of options. So universal is permanent insurance with a variety of flexible options. Variable life insurance is also permanent life insurance, which is a whole life product. Okay, variable whole life product is permanent insurance with cash values that fluctuate based on market performance. We're going to go deeper into that so that you have a better understanding of what I mean by that. So don't feel like you're getting lost because I'm not going so deep on that just yet. We will go deeper into variable in a moment. Okay, so term life. This slide is really all about term life coverage, like a term life insurance policy. So term life is also known as temporary insurance. A term life policy is defined by a specific number of years in which it will provide coverage and issue benefits. The typical terms of coverage include 10, 20, and 30-year plans. However, there are insurance companies that offer coverage in increments of 5 years, such as 5, 15, or 25, in addition to the typical terms. Coverage for a term life policy are calculated from the date of the initial premium payment. For example, John Doe established coverage with an initial premium payment for a 30-year term life policy on June 21st, 1993. On June 22nd, 2023, which is 30 years and 1 day later, John Doe is going to be without coverage unless he renews. It's a 30-year term life. If John Doe does not renew, he will no longer be responsible for making premium payments, and the insurer will no longer be responsible for coverage in the event of death to John Doe. No funds of any kind will be returned to the policy owner. The policy and the relationship, if not reestablished, simply expires. Okay. So term life is what it is. It's for a short term. It could be a long term if you consider 30 years long term, but when the lights just cut off on. I'm back on. But when that term is over, that term is over. Okay. So the term starts when the initial premium is paid, 10 years, 20 years, 30 years. If an event were to occur, someone were to die who was covered with term life during this period of time, then they would get, or whoever is attached to the policy would get all the benefits that is due. All right, so it's commonly known as pure life insurance. as it provides what is known as pure death protection. It's just protecting the life of an individual. It provides that protection in the event of that individual's death. But that's it, it's not covering anything else. There may be some term policies that have some riders attached to it that cover other things like disability, but a general term life policy is covering the life of that individual for the length of term that it's set for. And that's all it's covering. Okay. This type of insurance provides the greatest amount of coverage for the lowest premium. I want you to memorize that statement, or at least try to commit that to memory, write it down. That'll help you remember it, because it will be presented to you on your exam almost in those exact words, with that exact phrase. Term life insurance provides the greatest amount of coverage for the lowest premium. Means you can get an insurance policy for a large amount, meaning I want a 30-year policy for $1 million. I may not be able to qualify for a policy like that in a whole life product, but I might be able to qualify for that in a term life product, given that my health is in good condition in both situations. All right. Does not accumulate cash value. A term life product does not accumulate cash value. General term life policies. So you want to remember that a term life does not accumulate cash value. It provides the greatest amount of coverage for the lowest premium, and it basically provides protection for the length of that term. All right. So there are a few different types of term life categories. Level term. A level term is most common type of temporary protection. The word level refers to the death benefit that does not change throughout the life of the policy. Okay, the death benefit is the amount that when you say I got an insurance policy for X amount, that's the death benefit. I got a $1 million life policy. That $1 million is the death benefit. A level term life policy means that death benefit does never change. Okay. An annually renewable term. Remember what I talked about, taking words for face value. Annually renewable term means it either renews annually or it can renew annually, right? So it's the purest form of term insurance. The death benefit remains level, and the policy can be renewable each year without proof of insurability. Premium increases annually according to the attained age as the probability of death increases. We're going to discuss attained age in a few slides. We're also going to discuss proof of insurability in a few slides. But proof of insurability, again, if you take words for face value, it is probably like it sounds to you. Do you have proof that you're insurable? Provide proof of insurability. Sometimes it's medical records, health records, health assessments, statements from doctors, things like that, that help to prove that you're insurable, that you don't have some type of ailment or health thing that might be stopping us from making a decision to insure you. All right. An attained age is the age at which the individual was when insurance was attained. Okay, so when I apply for insurance, if I apply for insurance today, I'm 49 years old and I get approved for that insurance policy, then my attained age is 49, according to the insurance company. And they start the calculation of my mortality, which is how long they expect me to live from 49, which is when I'm applying, until whatever my expected lifespan is. They calculate it from that attained age of 49 to whatever that expected date is, and that's part of the calculation. We kind of discussed that a little bit yesterday, and we'll learn a little bit more about that on Sunday if you're here in the study session Sunday. All right, and decreasing term is used when the amount of needed protection is time sensitive or decreases over time. Just to give you an idea on decreasing term, because you will hear about decreasing term a little bit on the test. I think you'll have one question maybe related to this, but if I'm not mistaken, that question is answered in either one or two ways. It either relates to credit card balances or a mortgage, and I'll explain what I mean. A decreasing term policy is generally attached to a mortgage. This type of policy is used to protect a mortgage, a home, okay? So let's say there's a husband and wife. The husband is the breadwinner and the wife doesn't work, all right? The husband wants to provide coverage so that if he dies, the house mortgage payments will be covered, okay? So a decreasing term insurance policy would protect the value of the mortgage until the mortgage is paid off. So every month that you pay on your mortgage, it decreases, right? The amount that you owe to the mortgage company or the bank decreases. So does the face amount of the policy, because it's only designed to protect the amount that would be needed if the individual who owns the house or is paying for the house dies. Okay, so decreasing term coverage on your exam is going to be related to an example of protecting a mortgage or paying off a credit card balance that starts right here, and as you pay it down, it decreases. So it's kind of why I put it in a triangle, so you could kind of visualize a mortgage that's this big, and as you pay it over 30 years, it gets smaller and smaller. When the home is paid off, the value of the policy is zero as well, because it's no longer needed. That's how a decreasing term is set up. All right, so here's some essential knowledge. Return of premium, that is a term you should be familiar with. You will see that on the exam, that term, return of premium. Return of premium in general, though, is a type of life insurance policy that pays an additional death benefit to the beneficiary equal to the amount of the premiums paid. Okay, so it's it basically, if a person was paying for insurance for 30 years and the total amount of premiums they paid into that policy was $250,000, then when the insured individual died, the beneficiary will receive the face amount of that policy. Let's say the face amount was $1 million. They would receive the $1 million, but they'd also receive that $250,000 of all the premiums that were paid too. Okay, it's like an additional, it's almost like an additional rider attached to a policy, or a different additional provision attached to a policy that allows a person to get those premiums back. All right, renewable term and convertible term. They're two separate things, but we're going to learn about them in relation to one another. A renewable term is a provision that allows a policy owner the right to renew the coverage at the expiration date without the evidence of insurability. We talked about evidence of insurability a moment ago. The new policy will be based on the insured's current age. We talked about attained age a moment ago as well. So renewable term means at the end of that term, if it's a 30-year term, at the end of that term, if you have a renewable term policy, which is probably going to cost you a little bit more money at the end of 30 years, You don't have to show them evidence of insurability. You don't have to show them that you're healthy and that you don't have, any diseases, or your body is still, in good shape. You don't even have to show them your income or your credit worthiness or any of those things that they might typically check the first time you apply. It's just renewable because you're paying for it, basically. Okay, or you elected to be covered with that type of policy. Convertible, on the other hand, is a provision that provides a policyholder the right to convert from permanent to temporary, all right, or from temporary to permanent without evidence of insurability. So the evidence of insurability factor is the same in both scenarios, but convertible is converting from term to whole or whole to term, right? Renewable is renewing the term altogether or establishing a new term altogether without having to provide evidence of insurability. If you are in the room, type a 1 in the chat if you understand what I mean by evidence of insurability. I would like to see a response from each of you if you can, so that I make sure that I've covered that thoroughly. Well, thank you, Maya, for your engagement. Thank you, Lily. Thank you, Tariq. Okay, cool. Awesome. Just wanted to make sure that's making sense. If you understand evidence of insurability, it kind of helps you understand some broader concepts of how insurance coverages are approved or denied, or different other terms that you'll learn later on too. All right, so term, we talked about term insurance, term life. That's what this whole section is about. Term equals 10. That's just a way that you can remember it for test purposes. Term life is temporary insurance in 20, 30 years. Okay, has no cash value, typically provide no living benefits. There are some terms that do, but definitely don't have any cash value. So this is the biggest part you want to know. Has no cash value, specific period of time, temporary insurance. All right, key terms to know. You talked about the attained age. Again, like I described, it is the insured's age at the time that the policy is issued or at the time the policy is renewed. If I got a policy when I was, gotta call you back, excuse me. That might be an appointment, but I gotta call him back. The policy, if I attained a policy when I was 25, my attained age was 25. If I renewed that policy at 55, my attained age is 55. Okay. Cash value is a policy savings element or living benefit. So when we talk about builds cash value, a term life policy doesn't build cash value. There's no savings element that you could withdraw from and utilize for your own purposes, as in maybe giving yourself a loan. Some of these policies we're talking about, whole life policies and things you're going to learn about shortly, do build cash value and do allow you that benefit. Face amount. The face amount is the amount of the death benefit that's stated in a life insurance policy. Basically, you got $1 million life insurance policy, you got $1 million worth of coverage, $1 million is the face amount. All right, endow, to endow, all right. The cash value of a whole life policy has reached the contractual face amount. So a policy endows when the amount of premiums paid into it equals the face amount of it. So for example, I applied for $1 million. I keep using $1 million insurance policy because I want you to get that in the head. I want you guys, I want you, it's easy math, okay? It's easy math. $1 million, if I apply for $1 million of insurance and over the course of my life, I end up paying $1 million into that policy, at the moment that the amount of premiums that I paid is $1 million and it matches that face amount, then the policy endows, which basically means got full access to that cash value, right? If I wanted to take out a whole $1 million, I could, because I paid $1 million and I still have the death benefit of $1 million if I do. Okay. That's a way that long-term wealth and generational wealth is built in this company, and the way that we provide products and services. And you'll learn more about doing that kind of stuff the further along we get. But that's the power of some of the things that we're able to do in this company. All right, level premium. Level premium, the premium that does not change throughout the life of a policy. Simple as that. A premium is a payment. The level premium is the same throughout the life of the policy. Take it for face value. Non-forfeiture values. If you understand what a forfeit is, just like in sports, if a team forfeits, they're giving up, they're quitting, right? They're giving up all their rights, right? To pursuing a win in the game. Non-forfeiture means it cannot be forfeited, can't be given up, can't be taken away. So a non-forfeiture value is a benefit in a policy that the owner cannot lose, even if the policy lapses or is surrendered. A non-forfeiture value is like a vault. If someone has a non-forfeiture value on their policy, then that means it sticks. Even if their policy lapses and they come back to the company, whatever the non-forfeiture value was at that time, it's going to remain that when they renew. All right, policy maturity. In life policies, the time when the face value is paid out is the policy maturity. So the policy matures when the face value is paid out. The whole point of a life insurance policy is to protect someone's life, okay? If I have a policy that's covering myself and my wife is the beneficiary, when I die, my wife gets the death benefit, right? When the insurance company pays that death benefit to my wife, the policy is matured. It did what it's supposed to do. It's reached its stage of fulfillment, okay? It's reached its maturity. All right, qualified plan, a retirement plan that meets IRS guidelines for receiving favorable tax treatment. We'll get into that a little bit more on Sunday, but a qualified plan is related to favorable tax treatment. If you can remember qualified plan, favorable tax treatment, that'll go a long way to answering a question or two on the exam. Securities, we'll learn more about that in a moment, but securities are financial instruments that may trade for value such as stocks, bonds, and options. Suitability, a requirement to determine if an insurance product is appropriate for a customer. This is an important word to remember. You will see this word on the exam. The concept of suitability, and again, take it for face value, it'll help you remember it. Think about suitability, somebody putting on a suit. When a man or a woman, if you put on a suit, in order for it to look its best, it needs to fit its best. It needs to be cut, to have the right cut, right? It needs to be presented in the right way for it to look the best on you. Suitability. Does the product fit the customer that you're trying to match the product with? Is it the right product for their situation? Is it suitable for them? Suitability. Put a 1 in the chat if you understand what I mean by suitability at this point, because it will be on your test. Okay, awesome. Thank you. All right, good, good. So we're getting through. All right, next slide. All right, now we're going to get into whole life. We talked about term life, and then we talked about some keywords and terminology. Now we're going to talk about whole life insurance, whole life products. Remember, we said a whole life product protects someone's whole life, and premiums are going to be paid into that policy for the insured's or the policy owner's whole life. Okay. Unless in the case there's a, they prepay it and it endows prior to, we talked about endow, like there are some policies that you can pay up in advance, then they may not be paying their whole life. Okay, but based on the typical schedule, it's scheduled for payments to be made a person's entire lifetime. All right. So a whole life policy provides lifetime protection and includes a savings element, cash value. So when you start talking about universal banking strategies, or you start talking about generational wealth, legacy building, leaving legacies for family, it's in whole life policies that we start to make those connections. All right, whole life policies endow at the insured's age of 100, which means the cash value created by the accumulation of premium is scheduled to equal the face amount of the policy at 100. So the way that a whole life policy is calculated to where, okay, if you have $1 million life policy and you are 25 when you get that policy, they do a calculation of your calculation all the way up to 100. And they start with the goal is to get to $1 million by 100. If you live to be 100, then you would have paid $1 million into your policy in this scenario. But you'll be able to do whatever you want to with that money and still have $1 million as the death benefit when you pass. Okay. So premiums for whole life policies are usually higher than premiums for term life policies. Okay. And regardless of the mode of premium, they are paid for the insurer's entire life. If you were here Monday, we talked about the mode of premium is just the frequency in which the premiums are paid and the schedule upon which the premiums are paid. But for whole life policies, they're paid for the insured's entire life. That will almost likely be a question on your exam. It may not be worded in that way, but you will have to understand that whole life policies, premiums are paid for the person's the insured's entire life. Commonly referred to as permanent life insurance. So it's also referred to as permanent life insurance. On exam, they may refer to it as permanent life insurance and not whole life. So understand what they're asking you. Permanent is whole. Okay, your permanent time on this earth. All right. So ordinary life. Ordinary whole life, also referred to as straight life. Policy owner pays a premium from the issue date of the policy until the insurer's death or until age 100, whichever occurs first. That's just the basic ordinary life policy. That's how it's designed. The policy owner pays a premium for the entire life of the insured. Remember, the policy owner and the insured may or may not be the same person. If I get an insurance policy on my child, I'm the policy owner, my child is the insured. He's the person or she's the individual that the insurance company's life is insuring, or whose life they're insuring, okay? But if I get a policy on myself and I'm making the premium payments, I'm the policy owner and I'm the insured, all right? Single premium. A single premium whole life policy, that's what this SPWL is. is designed to provide a level death benefit to the insured's age of 100 for a one-time lump sum payment. Single premium, remember it, take it for face value. Single premium. A premium is a payment. How many times are we making it? One single time. A single premium whole life payment. So it's a whole life policy that one payment was made into it. That's it. Okay. The policy completely paid up after one premium and generates immediate cash value. Okay. And it can also continue to grow if there is interest earning elements attached to that policy. All right, whole life policies are equipped with living benefits such as cash value accumulation, policy loans, and non-forfeiture values. It's just a reminder of some of the things that whole life policies can do. You look up here on this side, it says limited pay life. Write some of this stuff down that I'm telling you, wait till I tell you to write it down, but so that you're not trying to write every single thing down. But this will be on your exam. Limited pay life. Limited pay life policies, they're whole life policies, but again, in the face value, limited pay. Pay is going to be limited. How I pay is going to be limited. Something is going to be limited, right? Designed so that the premiums, which are the payments for coverage, will be completely paid up before age 100. Cash value builds up faster for limited pay policies. So you remember that we talked about here, whole life policies endow at 100, ordinary whole life policies, policy owner pays premium from issue date until insured's death or until age 100. So the policy is designed, remember we talked about, for you to make payments as if you were going to live until you were 100. Well, a limited pay life policy, basically, if I was an individual getting a whole life policy and I didn't want to be making payments all the way up until I was 100, if I lived to be that long, then I would pay on a different schedule so that I could pay it up prior to me getting to that age. Okay, so the two most common versions of limited pay life policies are 20 pay life and LP 65. 20 pay life, why you think 20 is in there? Because I want to have it paid off in 20 years, right? In 20 years, if I get this policy when I'm 40, by the time I'm 60, I want to be done paying on it. So create my schedule, my payment schedule, my premium payment schedule where I'm done paying off on it by the time I'm 60. I don't want to keep making payments after that. Not till I'm 100. I don't want to do that. I want to start using that cash value after I'm 60 to do other stuff I want to do. Okay. LP 65, limited pay, 65, or excuse me, not limited pay, life paid up at 65. You can also think limited pay, life paid up at 65, meaning you paid a whole life insurance up by the time you were 65. The coverage is completely paid up for by the time you were 65. So the previous scenario example, I said I got this policy when I was 40, and then I wanted to pay it for 20 years. I want to be done paying it by the time I'm 60. This one is, I got the policy when I was 25, but I told myself the day I stop working at 65 when I retire is the day I want to start making these payments. So I want a whole life, life paid up at 65, an LP 65 policy. All right, the limited pay life policies are well suited for insurers who do not want to be paying premiums beyond a certain point in time. So it gives people some options. All right, whole life policy down here, just a timeline. Coverage begins at 20 years old. If I took a policy out at 20, right? Every year, 10, 30, 40, 50, 60, 70, 80, 82 years. This individual that's covered dies at 82 years. The death benefit is paid out to the beneficiary. Payments stop premium payments stop at this point. No matter how much the value of the premiums were at that time, the full amount of the death benefit is paid out, even though they scheduled the payments and they structured them to be fully endowed, that policy to be fully endowed when that person reached 100. They didn't live to be 100, they lived to be 82. So they never fully paid all of that money. It never fully endowed, but it did build cash value, and the full death benefit was paid regardless of the fact that they didn't live to be 100 or pay the policy all the way through age 100. Hopefully that gives you guys a little bit of clarification on whole life policies, term life policies. We are definitely at break time now. I do want to check your knowledge a little bit and ask a couple of questions. We're going to break for about 5 minutes and come back and finish with the rest of the session. But I do want to ask a couple of questions to make sure that you guys are retaining the most important pieces of information that we're studying. Okay, so question number 1, and then just type it in the chat. Do term life insurance policies build cash value? Yes or no? Awesome. Very good. Tarika, Maya, Lily, they do not build cash value, and you will have to answer that on the exam. So there you go. You got one more question committed to memory already. All right. If I, so okay, John Doe gets an insurance policy at age 25 and it expires, or excuse me, at age 25, and he renews that policy at age 65. Age 65 is known to the insurance company now as his blank age. Fill in the blank. It might have been a tricky worded question. No, good guess, Lily. I may have worded the question kind of oddly. So what I was looking for, I just want you guys to know that, understand the concept of attained age. Attained age, the date or the age at which an individual was when the policy was issued is the attained age. If they renew, the attained age is the new age that they were when they renewed. That is the age where the calculation of mortality starts. The calculation of mortality is kind of a way to determine how long you're expected to live from the time they start insuring you. Okay. All right, we're gonna go to a short break. It is now 7 o'clock on the dot. We're gonna come back at 7:05 on the dot and get started, okay? Got time to use the restroom, get something to drink and do whatever. I'll see you guys in 5 minutes. All right, it is 7:05. I just want to check to make sure you can hear me. Can you put a 1 in the chat just so I be sure you can hear me before I get started?
Yeah, we can hear you.
All right, awesome. Thank you very much. All right, so as a licensed agent in association with Pinnacle Elite, our parent organization, you are amongst a large team of individuals and families who are committed to helping other individuals and families realize their financial goals and pursue life with the confidence and peace of mind that positions them to live their happiest, most joyful life every day. All teams within the Pinnacle WFG family believe in what we call the 5 F's, and maybe not WFG, in the Pinnacle Excellence Leadership Development family, believe in what we call the 5 F's. They are family, faith, family, fitness, finances, and fun. Sorry. We welcome you to Excellence Leadership Development, and we're committed to your success and the realization of your biggest dreams. We mean that. It's not just talk. When you have earned your license and you're on the side that we're on, you will see everything that I'm referring to in those 5 F's and how we definitely embrace you and look forward to your success. All right, so second part of the session, interest in market sensitive life products. I do want you to maybe come off mute instead of typing something in the chat and just tell me, when you guys see this red line, what does that say to you in your mind? What words come to mind when you see a red line like that?
Fluctuate.
Fluctuate, very good. Anyone else? All right, fluctuate, very good. Stock market, up and down. Fluctuate was probably one of the best answers you can give, so awesome answer. Here, you're looking at a stock market, basically a line that is indicating volatility in the stock market, ups and downs in the stock market, okay? So this would be an example of a stock, excuse me, I didn't mean to do that. This would be an example of a stock losing money, and then this upswing is a stock gaining money. Now it's losing money again. Now it's kind of level, then it starts losing again, losing even more, right? That's how the stock market goes. I put this word variable here for a reason. I put that V right in that, you know, that downfall and then that increase, because that's the exact description of what variable kind of means, fluctuating, up and down. And if you look at this ticker, I mean, this line, this graph chart right here is basically, not only is it up and down, it's unreliable, it's unpredictable. You can't tell what's going to happen to it. All right, variable products. So I want you to kind of burn that visual into your memory a little bit, because it will help you. You don't have to commit to that, but we're going to go to another slide. It's going to go deeper, but it's going to help you on a lot of questions on the test. There's going to be at least 4, 5, 6 questions on the exam related to variable products. And I'll tell you why. Well, we'll get to variable in just a moment. Before we get to variable, we want to discuss 2 other types of market sensitive type products, okay, or what was the slide before? Interest in market sensitive product. Market sensitive products are products that are either sensitive to something that's going on in the market, like stock market or interest rate fluctuations, or sometimes it's related to inflation. Inflation increases the demand and pricing on things, which makes the value of the dollar decrease. And when the value of the dollar decreases, it's harder for people to, afford things. So some of these products, particularly like an adjustable life, allows the owner of the life insurance policy to have some flexibility to maybe make some changes to their policy in times of need. Okay. So an adjustable life policy, you can increase or decrease the premium or the premium paying period. How often is being paid. You can increase or decrease the face amount of the policy, right? You can change the period of protection from term to whole or whole to term, which is called converting, right? Remember we talked about that. Cash value only develops when the premiums paid are more than the cost of the policy, okay? Because an adjustable life policy is for life, and it is not going to endow until any values until the amount of premiums paid are more than the cost of the policy. But the biggest thing to know about adjustable life is you can adjust the premium, you can adjust the premium payment period, you can adjust the face amount, you can adjust, convert it from whole to term to whole, okay? You just need to understand that concept. That's all. None of these exact wordings you have to memorize. You just need to understand the concept of adjustable life. It allows you to adjust. What are the things that can be adjusted? The amount of the premium, when the premium is paid, face amount. Maybe whether or not it's whole or term. Those are the things that can be adjusted. Okay. Universal life, you got Mr. Policy Owner over here. He's making all those adjustments. The benefit of these types of policies allow the policy owner more flexibility, more control over their options. A universal life policy, remember we talked about a universal life policy is a whole life product, okay? It's a universal whole product. The generic name for a universal life policy is flexible premium, adjustable life. Okay, flexible premium, just like it sounds. Premiums are flexible. You can be flexible with how you pay them, when you pay them, or when you pay them, how much you pay. Okay, adjustable, can adjust different things on the policy, face amount. Okay, you can increase or decrease the amount of premium being paid. Policy owner may skip payments on a universal life. Okay, and the policy will not lapse if sufficient cash value exists to cover the skip premium, or the policy will expire. So this will be on your test. You will need to know that a universal life policy builds cash value because it's a whole life policy product. Okay. You will need to know that the owner of a universal life policy can skip payments and not have their insurance policy lapse if there's sufficient cash value to cover the skipped payment. So if they got a cash value build up of a certain dollar amount, they could skip a payment and the insurance company would just take the payment out of their cash value. Okay, and their policy will not lapse. It's in bold and it's highlighted with that rectangle on there because you're going to see that on the test. It will not lapse. All right, change the period of protection. You can change the period of protection from, term to whole. If you wanted to, it's generally based as a whole product. Partial withdrawal or partial surrender of the cash value. So you're allowed to basically take money out, withdraw, make a loan, loan yourself money from your policy. Okay. There's two options in universal life policies. There's two death benefit options. Option A, the death benefit remains level the entire time of the policy, while the cash value gradually increases, thereby lowering the pure insurance within the latter years. Don't worry about that part. I don't want you to commit that to memory in terms of lowering pure insurance within the latter years, because it's not going to necessarily be asked of you on exam. But understanding that death benefit A is a level death benefit B, or excuse me, yeah, death benefit B includes an annual increase to the death benefit so that the cash value and the death benefit gradually increase each year, or the death benefit increases as the cash value increases. So you can put in option A as you pay more into the cash value, the death benefit also goes up, right? You're basically building more funds to utilize and maintaining that full death benefit at the same time with this option. You just need to know that those options exist. You don't have to necessarily memorize those two options, but you do need to know that options exist, because the wording on some of these exams might try to trick you up. All right, there's also two premium payment options on universal life policies. A minimum payment, the amount needed to keep the policy in force for a current year, or a target payment, a recommended amount to make sure that the policy stays in order to cover the cost of the insurance and keeping it forced throughout its lifetime. So they give a minimum amount, and the amount that if you wanted to stay on track with your goal for the insurance policy, you can pay this amount, or you can pay a minimum amount. Okay, flexible payment, universal life. So universal, as you can tell, I kind of went in depth with that for a reason. There's so many options related to universal, okay? You don't have to memorize all those options. You just have to memorize that universal means it's a lot of options. It's based on a whole life product. Definitely builds cash value, because all whole life products build cash value. It will not lapse if a payment is skipped, as long as there's cash value to cover the missed payment. And this last part right here, Universal Buyer's Guide. We talked about that on Monday. If you're here Monday, when you see that on the exam, a question related to the buyer's guide is going to relate to a universal product on the exam. And we talked about remembering like Universal theme park, so many attractions, so many shows, so many restaurants, that you need a guide to get you around the park to make sure you're making the best use of your time. That's what a buyer's guide does for universal life products, because there's so many options, okay? The federal government wants to make sure that citizens are informed about what they're about to purchase and the decisions they're about to make, because there are so many options with a universal life policy. All right, so I said that we would talk about variable, and we would. That first slide where I went over the V in the stock market. The reason I did that for a reason, because on the exam, I think they ask you about this topic 3 or 4 times for a reason. They want to make sure that you understand your role as it relates to variable products. So first off, a variable whole life insurance product is just that, whole life insurance with variable flexibility, a level fixed premium, but an investment-based product, variable investment, okay? Variable, like the stock, like that first slide. Guaranteed minimum death benefit exists, okay? Because it's fluctuating, it's based on fluctuation in the stock market, They can't guarantee a maximum, but they do guarantee a minimum death benefit, right? The cash value fluctuates. That was a great response when you said fluctuate. Okay, the cash value fluctuates. Variable, I wrote this in red, with performance, cash value fluctuates with performance of the portfolio in which the premiums have been invested by the insured. The policy owner bears the investment risk in variable contracts. So the policy owner bears the risk. You give money to the insurance company. You say, I want you to put my insurance money into a vehicle that could possibly make me more money. And the insurance company says, okay, policy owner, we're gonna do that for you. But if we lose, if this money gets lost, where we put it, that's on you, okay? You wouldn't want that, right? Variable contracts, variable insurance policies are advantageous when the market is doing really well. Otherwise, they're not something we want to look at. And as a result, because they're based on so much fluctuation and volatility, you must have, look at the very bottom line on the page. Agents selling variable life insurance products must have received a securities license. Write that down or commit that to memory, because on the test, you will get that question probably at least twice in a couple of different ways. They want to make sure that you understand that you need to have a securities license to sell variable products. So they'll ask you that question on the exam a couple of different ways. So when you think variable, think of red, all of this red I got on here to try to say, hey, stop, I need a license for that, right? Variable universal life products combine many features of the whole life policy. So they got whole life policy, the flexible premium options of universal life, and investment component of variable life, right? It's a lot of options, but it's also based on an investment product that makes it a securities risk, which means you need to have a securities license to sell those products. We don't issue you securities licenses. You're not applying for a securities license. The one that you're going to earn is not a securities license. So you need to know it for the exam, but it's not something that we're going to embrace along with you in trying to attain. I don't have a securities license. I don't think Tristica or Cherry or DJ have a securities license. I don't even know if Eric Olson has a securities license. Eric Olson's the president of our company. All right, we're almost done. Other types of policies, interest sensitive whole life policies. It is what it sounds like, interest sensitive. It's sensitive to interest, it's sensitive to some type of market, right? A whole life policy that provides a guaranteed death benefit at age 100. The policy provides the same benefits as other traditional whole life policies with the added benefit of current interest rates, which may allow for either greater cash value accumulation or shorter premium paying period. This policy provides for a minimum guaranteed rate of interest. Okay, you do want to remember that interest sensitive whole life, if you take it for face value, interest sensitive whole life, minimum guaranteed rate of interest, sensitive to the interest rate. So we're going to guarantee that you don't lose but so much, interest sensitive. Okay, but what it also does is it allows an individual to get a policy when the rates are low and avoid the inflated prices or inflated premiums later on when inflation is higher. Okay, which allows them to build more cash value in their policy because inflation is higher, but the value of their dollar is greater than inflation because the value of their dollar that they're putting into this policy is greater than inflation because they got it when the interest rates were lower. All right, indexed whole life. The cash value is dependent upon the performance of the equity index such as an equity index such as S&P 500, although there's a guaranteed minimum interest rate. Okay, indexed whole life. So whole life product based on the stock market, but an equity index is a number of stocks, a grouping of stocks. An index is a grouping of stocks or a grouping of companies. And the average measure of their performance together is the performance of the index. Okay. And your policy matches what that index does. That index is up, your policy gains. That index is down, policy probably loses, unless it's an indexed policy that caps off any losses. You'll learn about those types of things later. Okay, but indexed whole life, guaranteed minimum interest rate, interest sensitive whole life, guaranteed minimum interest rate. You might get those on a test for sure. I mean, not for sure, you might get those on a test depending on which version of the test you get. Joint life, these, you will get 2, maybe 3 questions about these 2 concepts at the bottom on the test for sure. So understanding this is kind of important, but it's not hard to understand. Okay, take these words for face value. Joint life, a joint life policy is a single policy that insures 2 or more lives. Okay, the policy can be term or whole life insurance. The premium on a joint life policy is less than the premium would be if each of the individuals in that policy had individual policies. So if I'm protecting myself and my wife in one policy, that's a joint life policy, the total amount of that premium for that policy is less than what it would be if I got a single individual policy on myself and a single individual policy on her. It would be less on a joint life situation, okay? The premium, because the premium is based on the joint average age between the ages of the insureds. So they take the 2 ages of the individuals, or if there's 3 or 4 people in the policy, they add those ages up, divided by the amount of people, and that gives you the average age, and that's where they start the calculation of mortality. Okay, and then the death benefit, go ahead.
Sorry, I was just giving you a time check that it was 7:27. Sorry.
Okay, we're almost done. Thank you. The death benefit is paid upon the first death only. So what you want to know about joint life, that it protects 2 or more lives, is one policy protecting 2 or more lives. You also want to know that it's based on the joint average age between the insureds. The insurers are the individuals that the policy is protecting. And then the death benefit is paid upon the first death only. So in a joint policy, if it's me, my wife, and my child, when I die, that's when the death benefit is paid out. Okay. Well, if I'm the first to die, but that, I didn't mean to say that. Me, my wife, and my child, if I'm the first to die of the 3, the death benefit is paid out. If my child is the first to die of us 3, then the death benefit is paid out. If my wife is the first to die of us 3, then the death benefit is paid out. But the benefit is paid out when the first person covered by the policy dies. Okay, the first insured dies. We're almost done. A couple more minutes. Survivorship life. Okay. Second to die. We talked about the joint life, the first to die. Survivorship life, second to die, or the last survivor. Okay. If you think about the show Survivor on TV, like it's based on the person who can survive, who can hang the longest, right? The last man standing. So it's kind of how a survivorship life policy is. It's a single policy, just like a joint policy that insures multiple lives, 2 or more lives. It can be term or permanent. whole or, term, just like a joint life policy. It can be used to offset the liability of estate taxes upon death of the last insured. Okay, because of the way it's structured and designed, how money is fed, how funds are fed into that policy, and how long it stays in that policy until the last person dies, then it definitely offsets tax liabilities. And you'll learn more about that later. The biggest thing you need to learn, though, in this survivorship life is this: the death benefit is paid up upon the last death only. Okay, joint life, death benefit is paid up on the first death. Survivorship, death benefit is paid on the last death. So if that policy is protecting me, my wife, and my child, I die, no death benefit is paid up. The insurance policy still covers my wife and my child. My wife dies, no death benefit is paid out. That policy is still covering the life of my child. Okay. A benefit of that might be a more affordable coverage. There's no death benefit for my child if my wife and I both die, but my child was covered at a very early age. They never ever have to get qualify for insurance again. So no matter what happens to them in their lives, they got permanent life insurance, right? And if they were to die, they can elect that beneficiary to be their child, okay, with an insurance policy that they never paid for, okay? So that's how wealth is built, generational wealth, these types of things, these types of situations. Takes a lot of thought sometimes to get to that type of planning and a lot of conversation with the client. But there's the power in all of these types of policies that we have access to. So I hope that I did not present so much information to you that it made it a little confusing, and I hope we did clarify some things, but I tried to point out the things to you that I know would be on the exam. And those are the things that for sure you need to commit to memory. You need to embrace. The other things, there are some things that as you're studying, you're reading, we're done with the, by the way, but I do want to say this. There's some other things that as you're studying and taking your practice exams, that you will start to develop the knowledge of them just by going through the practice exams. So there are some terms that I'm not covering. But if there's concepts and things that I think will answer multiple questions, those are the things that we're covering here. Because again, the goal is to get you to pass the exam with a 70, not with a 100. If you pass with a 100, great, but that's not the requirement. So that's not the goal. The other part of information that you don't learn, you will learn once you start earning money, once you start working with our team, once we start training and helping you develop. Just like me, I'm learning more and more every day by teaching these classes. So if you have any questions about anything we covered tonight, term life, whole life, variable products, now's the time to come off mute and ask your questions. Okay. So sounds like we don't have any questions. Do you feel like, I just need maybe a yes or maybe, I don't know, in the chat. Just, do you feel like the information we covered tonight is helpful to you? Thank you, Maya. Thank you, Lily. All right, awesome. That's the whole goal. You know, I do this, I'm gonna be doing this every week for a long time now, going forward. And whether I'm doing it with one person or 3 people or 30 people, thank you, Tarika. I hope I'm saying your name correctly. But you know, I'm glad to be able to do it regardless of how many people are here. So thank you 3 for being here. Right. If you are still in need of more learning, we're going to do it again on Sunday, 4 to 6. We go over annuities, provisions, riders, and we also go through the exam, some sample exam questions so that you get some practice learning in on how the exam is laid out, how the questions are asked, how they're presented to you. All right. So thank you very much. Y'all have a great evening. Keep studying, keep taking those practice exams. I can't emphasize to you any more than I am now. Like taking those practice exams over and over and over is vital to you, to your confidence, to your knowledge, to you passing the exam. There's going to be some things you're going to learn just because you've seen it on the exam, taking the practice exam 4 times. You got that question wrong 3 times. The 4th time you remember that it was this answer, and now it's committed to memory. Some of the things you're going to learn that way. So keep taking those exams, keep studying. We'll see you guys on Sunday.
Thank you.
You're welcome.